Good morning or good evening, and thank you for joining us for the Global Network for Advanced Management Annual Investment Competition. My name is Raquel Begleiter. I'm a third-year JD MBA student at Yale, and I will be your host for today's competition. This is the Global Network for Advanced Management's 5th annual investment competition. It's a one-of-a-kind contest dedicated to equity investments sourced from top business students around the globe. Student teams from our 30 global network business schools are invited to submit 5 investment ideas from the country in which they attend school for a chance to win cash prizes. This year, we had 24 teams participate from 16 global network business schools. Competing teams are evaluated, and winners are recognized for excellence in 2 areas: performance and security analysis. Team performance is measured over several months. Each team selects 5 investment ideas, which are tracked from November 1st through April 30th. A $3,500 performance prize is awarded to the team with the highest performance. The second place team wins $1,500. Prizes are sponsored by the International Center for Finance. The competition in which we are participating today gives teams the opportunity to showcase security analysis skills and take home the Security Analysis Prize. Each team selected 1 stock from the portfolio and submitted a report. The reports were judged, and 4 finalists were selected to pitch the idea today, virtually to a panel of judges. First place will receive a prize of $3,500, and second place will receive a prize of $1,500. The event is hosted by the Global Network for Advanced Management and the International Center for Finance. I would now like to introduce the judges and thank them for participating today. Eddie Tam, the CEO and CIO of Central Asset Investments. Mr. Tam founded Central Asset Investments in April 2005 and oversees the management of the firm. Mr. Tam is also an advisory board member for the International Center for Finance and has judged the competition for the past 5 years. Welcome. We've got Michael Alpert, portfolio manager and chair of the Wealth Management Investment Committee at Shale & Company. And finally, we have Adam Abelson, chief investment officer at Shale & Company. Welcome, judges. As I mentioned, 24 teams from our global network schools submitted reports for a stock in their portfolio. Out of this group, 4 finalists were selected. These 4 finalists are Wujiao Cheng Alliance from Fudan University School of Management. Thank you for joining us at 9:30 p.m. on a Friday night. Singapore Bulls from National University of Singapore Business School. Thank you as well. It's 9 p.m. for your team. GSB from the University of Cape Town Graduate School of Business. And finally, we have Brazil Next from FGV EAESP. Welcome, teams. I will now explain the guidelines and the order of presentations. Each team will have 10 minutes to present their stock before the judges. Judges will have 12 minutes to ask questions. Teams will be judged on 1, the quality of stock analysis and research, 2, the investment thesis, and 3, presentation skills, including the quality of presentation delivery. Wujiao Cheng Alliance will present first, followed by Singapore Bulls. We will then take a 10-minute break. GSB will then present, followed by Brazil Next. Judges will have 10 minutes to deliberate, and the winners will be announced at 10:30 a.m. Eastern Time. Let's begin with the first team. Just one moment as we get the first team ready to go.
Hello, can you see my screen, the PPT? Hi, anybody?
Yes, we can see your PowerPoint.
Oh, okay. So hello everyone, we are Wujiao Cheng Alliance from Fudan University School of Management. In order to obey the government's order to prevent the coronavirus, we have to stay at our own homes and present from different windows. Sorry for the inconvenience, and thank you for your understanding. The favorite stock we have chosen is Jerry Group in oil service industry. The reason why we chose Jerry mainly attributes to three primary factors. First of all, oil service cycle is climbing. Domestic shale gas market demand is booming, and Jerry is expanding in North American market. What's more, Jerry's equipment had a strong competitive power, especially its electric-driven fracturing skid. Last but not least, Jerry's intrinsic value is larger than its stock price, meaning Jerry is devalued on November the 5th when we wrote our report. So we give it a clear buy with 22% upside return. It turns out that on January, Jerry's stock price has reached our target price, which has confirmed our prediction. Next, I will give a brief introduction of our value investment analysis. First is a quantitative analysis. Jerry is founded in 1999, but 2002 would be a significant milestone to shift from trade to independent research and development. We can see the proportion in revenue that Jerry's most profitable part comes from the below wellhead, especially well drilling and completion equipment. For example, the fracturing equipment. More than 70% of Jerry's equipment are used on shale gas exploitation. Shale gas exploitation has higher technical requirements. You need to break Ramo by high pressure water and dissociate oil and gas. So Jerry has invented 7,000 HP electric-driven fracturing skid in 2018. It is expected to greatly improve the fracturing efficiency and help the efficient development of shale gas. Next, let's see the demand and supply analysis. Firstly, the consumption of petroleum and natural gas is larger than the output of it, so the oil gap is increasing every year. Secondly, under the energy resource safety strategy background, unconventional oil and gas, such as shale gas, is in high demand. So the well drilling and completion equipment is in high demand. So the demand of fracturing equipment is skyrocketing. So the future of Jerry is worth expecting. Next, let's see the industry analysis. We can see this is the oil service industry trend. Jerry focuses mainly on the well drilling and completion part. The fracturing equipment is not only used to exploit unconventional oil and gas, but to increase the production of conventional oil and gas. We can see a simple PEST analysis. For the politics part, domestic oil service companies are encouraged by the Chinese government. For the economic part, central banks are reducing interest rates. There will be a loose macro environment. Oil price is at its low level now, so there will be a strong support in the future. For the society part, oil service company is picking up, and people have a large demand for oil and gas. For the technology part, Jerry has focused on fracturing chunk as its competitiveness. So this industry's entry barrier is really high, but as a private enterprise, Jerry is number one to compete with other two state-owned enterprises. But Jerry performs better and is more competitive in electric-driven fracturing equipment, which is more efficient, more economic, and more environmental productive. Next, let's see the market analysis. For the American shale gas market, after 10 years of fast development, 1/3 fracturing equipment is in replacement period. Jerry's equipment is cheaper than Americans, so it is very advantageous. For Chinese shale gas market, it's still in progress, but we predict that by 2040, there will be 231.6 billion fracturing market. So there'll be a very large market for Jerry to support its revenue and profit. Next, we can see the business model canvas. The 4 elements in the right is the value creation part. Jerry not only provides sales services to oil service companies, but also sells services to oil companies, aiming at the high-end market. So it provides a differentiation strategy with other oil service companies. What's more, Jerry focuses on fracturing chunk and the shale gas market. So it provides a lease and sale business model. The three elements in the left is a value support system. Jerry is on the upper and middle reach of the value chain and provides cost advantage to the downstream of the supply chain. What's more, Jerry provides the role of overseas authorized company's agency and has many North American orders, so it benefits from its early overseas outlay. Below is its value realization part. We predict that by 2021, Jerry's revenue would be 10.6 billion, net profit will be 1.9 billion, which will far exceed its company's historical performance, and its share price is believed to achieve a rebound and growth that matches its performance. Next, let's see the financial analysis. For the profitability ratio, Jerry's gross profit rate and net profit margin is rising. For the activity ratio, Jerry's inventory turnover and receivable turnover rate is improving. Its operating efficiency is promoting too. For the liquidity ratio, Jerry has maintained a higher level. So all the financial ratios are good. Jerry is going beyond itself these years, aiming to pay back its shareholders as well as the society. Next, let's see some quantitative analysis. Shen, please.
Okay, we estimate the value of Jerry's equity by discounting free cash flow to equity. Then we use CAPM model to calculate discount rate. The forecasted components of free cash flow to calculate FCFE. Here are some important assumptions we've made. Jerry's depreciation expense growth rate will maintain at the last 3-year average level, which is 7.5%. Jerry's investment in fixed capital and working capital will both maintain at the last 5-year average level. So we assume Jerry's target debt ratio is 50%, and it will equitably grow from the current 30% in 4 years. Also, we believe the rapid expansion of shale gas market will drive Jerry's profit to increase much faster. We divide this growing process into 3 stages. According to the data, the Chinese shale gas production will be 227 billion cubic meter per year by 2040, which indicates a nearly 50% CAGR market for the next 20 years. One of Jerry's major business, drilling and completion, is highly related to shale gas market and will benefit from this rapid development. In addition, we have predicted Jerry's revenue by 2021. The CAGR is around 32 for the next 3 years. Based on all the information, we believe Jerry will benefit from oil and gas industry recovery in short run and will benefit from shale gas market growing in the long term. So we input all the numbers into formulas and divide FCFE growth by 3 stages. The picture on the right shows the profit growth and forecasted FCFE in 3 stages. Then we use Shanghai Composite Index as market and Jerry's beta to find a discount rate and calculate Jerry's fair market price. It is 37.11. Finally, we use multiples to test the result. The 2 pictures on the left illustrate both Jerry's PE and PB are at historical low level. Its upside space is larger than downside risk. So we also find Jerry's competitors in oil service sector and list 2 types of their PE ratios. If the median value can be approximated as fair value, Jerry should be undervalued and its price interval should be 35.94 to 14.63, which contains our target price, and this will support our results.
There are also some risks, such as oil price slump or Sino-US trade friction or black swan event like the coronavirus. But we believe in the long term, Jerry will pay us some abnormal return. Thank you.
Okay, thank you very much. We'll now turn to the judges' Q&A.
You hear me?
Yeah.
I just want to know, where are these shale gas fields? Are they in Sichuan? And who are the clients of Jerry? And I think you mentioned that they compete with Sinopec. and CNPC, I would assume those are also their clients. So are they competing with their own customers? Yeah, because oil industry and gas industry in China is, I think, is monopolized by the state. So this is a private company servicing these national oil companies. Is that how it works? And it's, at the same time, they actually compete with them as well?
Okay. This is a display of Chinese shale gas reserve. The most part is in Xinjiang, Sichuan, and Ordos Basin. The biggest is the Sichuan Basin Shale Gas District. Another question is, you are asking who is Jerry competing with the other two state-owned enterprise?
Yeah, not only that, but I think I would assume the national oil companies are their clients as well. So they're competing with their clients. Is that how it works? That actually may or may not be a very good situation, right?
Oh, I see. That's why we told it's a differentiation strategy. It provides oil services. It provides products to oil service companies as well as provides products to oil companies. But because in China, after the refinery are all controlled by state-owned enterprise, oil service companies can only compete in the oil service sector. So Jerry is very smart that it has a overseas outlay very early, and it has many technical advantage. So I think it has many difference with other state-owned enterprise, such as in the West District. There's many small projects that the state-owned enterprise would not like to, or they just think it's too small, so they didn't enroll in the products. But Jerry, the private enterprise, will try all their best to get the projects. Yeah, I think the small projects and the overseas orders is where Jerry differentiate from the state-owned enterprise. Maybe my members want to say something.
Just want to add some more information. Like enterprise like Sinopec, we can say it's a big enterprise, but maybe it's not too big to fail. And also, because the enterprise is so big, so they have so many different business in China, so it cannot focus on some major business. So that's the advantage of Jerry, because Jerry is kind of like in the niche market, so it can focus on the oil service and can do something more, just focusing on the shale gas or focusing on the equipment. So that is, you can say it's a disadvantage, but also it's advantage, and it's unique for this stock.
Well, you haven't really answered my question. Is like my first question was like, who are their clients? Like, I assume Sinopec is also their clients. So I'm just, it happens, but I'm just saying that it seems to me that they're competing with certain arms of their own clients. Is that correct? Are their clients Sinopec, CNOOC, or PetroChina? I assume it is, because I think the oil and gas industry is state monopolized. It's monopolized by the state, so those are the big oil companies. So I assume their clients are these companies.
Okay. Sorry. Can you hear me?
Yes.
Yeah.
Okay. Sorry, very sorry. Dear professor, just now I have some problem with the network, so I just get inside. Maybe you have received my messages. About your question, you are asking Jerry is competing with some of his clients, correct? Actually, we have mentioned in the last time PPT. Yes, correct. His clients should be some oilfield service companies, for example, Dagang oilfield service company. It's a very big oil field service company in China, and the oil field service companies, they serve the oil field companies just like Salopec, just like CNPC. You are very correct. Jerry is competing with his clients, but Jerry has his own unique advantages compared with some other competitors, some other players, more exactly, some other oil field service companies, just like Dagang oil field service company, because Jerry has his own equipment, and he built his own service team by his own equipment. But Dagang doesn't have equipment himself. They have to buy from some equipment companies, some manufacturer companies, just like Jerry, just like we mentioned in the PPT, some other oil field equipment companies. Maybe you're asking about that. Sorry, I didn't enter the video just now. If you have some more questions, please tell us.
And I want to mention something. I don't think it's a problem to compete with its downstream because it's a resource integration. I think maybe it's advantages.
Can you guys talk a little bit about what wasn't clear to me is how much of the growth you are building into the model comes from just working in China versus the overseas markets, and how much you expect to come from that, number one. And then number two, when you showed the list of competitors and you came up with the median PE, why are the other ones so much higher? What is it that makes those PEs so much higher?
Let me answer the first question. To answer your question, no, we didn't include the overseas business into our model. So all the CAGR, you can see the first stage, the second stage, we only calculate the business domestically. But we do input some information into the third stage. You can see the growth rate in the third stage is 7.52%. You may think that this number is too high because in the long term, you never see a country or economy entity can grow at that rate, but we put that 6.52 for the long-term growth, because we consider all the overseas business. They have about 30% of their business actually in the North America. But at that time, for the time being, their cost is almost the same as the revenue, so they didn't provide the profit. But we think in the future we can get a very significant development from that part. So we just consider that and input that into the third stage and just increase or put the growth rate a little bit higher. That's the first question. And for the second question, you can see, yes, their competitors, you can see their PE is very high because during the period from 2014 to 2016, the oil price have a sharply decrease in the international market. So all the oil service company have a very bad profit. And Jerry is one of the company that struggle from the situation, and they just move into a very good situation for now. So Jerry's profit is a little bit improving and in advance of the other companies. So that's why you can see other companies, their PE is very high because their profit is very low. But Jerry is already on the normal way, so we can see Jerry's PE is on the relatively lower than the average level. That's the answer.
Yeah, and I want to mention something. 2015 to 2017 is the sector trough. Oil price is very low, and giants in America like the big hugers and Schlumberger quitted oil service sector. But Jerry benefited from its efficiency operation, and it has invented 7,000 NGP electric driven skid in 2018. So its stock price has a large rebound. So Jerry, I think that's why Jerry is more good than the average level in PB and PE.
Okay, yeah, so I get that. It's a cyclical business, so the earnings are depressed, so the PEs are higher, but do you have a sense of what a normalized PE is? Because I thought you were using 25 times or something like that. And how does that compare historically through the cycle? Do you know?
Actually, I didn't get your question. Can you repeat it again? What's your exact meaning? You said we use TTM or?
Right. Well, so you're coming up with this median value PE, and you're applying it to your valuation, but you're admittedly saying that the other competitors that are driving the median PE are only high because their earnings are so depressed. So is it fair to use 99 and 87 and 59 times when those are on depressed earnings numbers, as opposed to what a normalized PE would be through the cycle? We're at the bottom of the cycle. So at the top of the cycle, all these PEs will be single digits. So I'm just curious, historically, if you've looked at where the PEs for these types of businesses run historically, because there are peaks and troughs.
I understand your question, and you can see in the chart, the first two and the last three, they are abnormal. The PE are abnormal, so we just exclude them. So the median term value is from the third one to the last fourth one, and you can see Jerry is at the lowest PE, and we use the median value just to test if it is a normal level. Just yes.
I have a question. I mean, Jerry is not a normal oil service company, right? They work exclusively on non-conventional shale gas, right? That's their niche. So, I mean, I've looked at this a long time ago, Chinese shale oil and gas, right? I mean, obviously, they're trying to mimic the boom that has happened in the US in the last decade, right? But my understanding is that the geology of each basin, even in the US, some are, lower cost than the others. So in the case of China, I kind of know a little bit. That's why I guess, the main fields are in Sichuan. But has something changed? I mean, my understanding is that it's not that economical to try to develop shale gas fields in China. The costs are, significantly, it's just more difficult geology. So what's the break-even point for these fields? So are they, really in still an experimental stage? Are they trying to see, are the Chinese trying to see if shale gas works in China? If that's the case, then maybe Jerry's business is not very long lasting. Maybe that's why they trade at this discount to their, competitors who may be just servicing normal conventional oil and gas fields. Have you looked at that?
2 minutes to go.
Right. Do you understand my question, right?
Yeah. I think it's really a tough question because Chinese share market is in progress. We have another graph that is only 4 years actually have a production. We compare with American shale gas revolution success, and we think there are 4 key elements. First is a resource endowment advantage. China also has the biggest shale gas reserve. Second is the cost advantage by fracturing technology. Jerry has the very good fracturing technology. Third is American government support on the policies. We can see that Chinese government also has many industry policies, including tax reduction, incremental subsidies, and National Energy Administration has many shale gas planning, 7 years of operation. And under the energy resource safety strategy, it will be beneficial to Jerry. The fourth is the integrative natural gas pipe network facility. This is unique in America. In China, we don't have this. So we cannot predict when the shale gas market will be actually will be very good. But we think there will be a large demand, and the government are doing policies to encourage unconventional oil and gas exploitation. So it continue to surge, and we think it will be very good to Jerry.
I think at the minimum, you should know the cost, the sort of break-even cost of
we've actually got
shale gas producers, and you have to compare that with the market price for natural gas. So if they're actually not economical, then this is kind of like an experiment that won't be a ongoing business. Actually, even in the U.S. they have this problem, right? Where if gas prices are too low, then the shale companies also get into trouble. And same with the non-conventional oil companies in Canada, like the oil sand. Unless oil is like 60 or above, otherwise they will lose money. So I think you should also understand the underlying market as well.
Thank you so much, Team 1. At this time, we're going to bring in Team 2. So just hold tight. Okay, welcome Singapore Bulls. Take it away. We can't hear them.
This opportunity of presenting in front of you all. So we are Team Singapore Bulls from National University of Singapore. And one of our members is in quarantine, so we are also facing the same issues. So it's 5 Asia. So hey, Leon is there. So we are starting with our presentation. We've chosen the stock AEM Holdings, which has seen exponential growth over the last 1.5 years, and that's what we're going to talk about today. So AEM Holdings is essentially broadly can be categorized into semiconductor industry, which has seen, like I said, exponential growth in the last 1.5 years. Its main business is back-end chip testing for one of the biggest semiconductor companies in the world, which is Intel. That forms a major part of its clientele at about 94% of its revenues. Its major product mix can be classified into two parts. One is the back-end chip testing of computer chips, and as well as cloud services chips. And the other part is which is based around 2.5 to 3% of its total revenues, is services and spare parts for the equipments that it manufactures. It has major factories in Malaysia, and as compared to STI, has seen a lot of return in the last, again, 5 years. It has done major acquisitions in the last 1 year, acquiring 3 firms. And since we did this analysis, it has also acquired another major firm. Coming to the industry has seen a lot of growth, majorly because of 3 main reasons. One is the growth of 5G. It is currently estimated to be about a 2.5 billion market, USD market, and by 2026, it's estimated to be about a 200 billion market easily. It has also, because of its key customer, which is Intel, it has seen exponential growth with the customer. It has a competitive advantage there, where it has produced specific customized testing services only for Intel. At the same time, out of the 5 major companies that are estimated to benefit from 5G, 2 and potentially 3 of them are its customers. So since 2002, it has been servicing all the top semiconductor companies in the world. it provides low-cost solutions, and it is also estimated to benefit from Internet of Things service. Intel is also slowly moving from CPU chips to cloud services chips, and that is where the customization part comes in, and that is why it has seen this exponential growth.
Okay, so we're just going to take you through the financials for the last few years. Now, as we can see, the revenue has grown at a CAGR of 60% over the last 5 years. There was a huge spike up in FY 2017 because AEM had been spending a lot of money into developing this HDMT technology, which is high density modular test technology, which is a service that they were able to provide to Intel. And that significantly boosted their revenues in FY 2017. They've been also able to maintain fairly healthy operating margins for the kind of business that they are in, and averaging out at around 15%. So if we look at the last 4 months from November of 2019, the Q3 results came out. The revenues were in line with what had been guided, and the PAT, however, had grown by 20% year on year. They also gave a revenue guidance of for FY19 in the range of 305 to 315, which is something that we had built into our model. Also, they recently appointed Chandran Nair as the group president. The idea behind that is that he has a great track record of scaling new business units, and they acquired him with the idea that he will be able to launch the new units that they have come up with, as well as acquire new customers for the company. They have had a buyback running for the last 2 years and recently acquired 100,000 shares at $1.74 a share. And they plan to acquire up to 10% of the outstanding equity, depending on the kind of prices that they get. They also did a recent acquisition called Mutest. Now, Mutest is a very interesting company which provides a certain service to Intel, which AEM was not providing earlier. It's a fairly big market for them. Also, they've been able to convince the founder and CEO to continue on in the company, which is very beneficial because there will not be any transition issues on that front. They've also come out with their FY20 projections, and the revenue projections are between 330 to $350 million, which is something that we've again baked into our calculations. So coming to our calculations, we basically did a DCF to begin with. We believe that this is a more appropriate model to follow. Some of the assumptions that we made were that the revenue would grow by 13% in FY20, which is in line with the slowdown that they had projected because of the investments that they are making into the new sort of sectors that Intel is entering into. Also, we have projected a growth rate of 15% between 21 and 25 and a terminal growth rate of 5%. The EBIT margin is likely to increase from 13% to 15%. This is because they will be getting in new customers who will not be having certain fixed ratios that Intel has been demanding. Intel has been on a more of a cost plus basis, whereas with the likes of Huawei, they will be able to garner higher margins, as well as the kind of new chips that they are getting into, the testing that they're getting into, they will be able to demand slightly higher margins from Intel. The WACC has been calculated at 9.05% using the last 1 year STI index and the 1 year interest rate in Singapore as the reference points. We have baked in a long-term growth rate, a terminal growth rate of 5%, which is equal to Intel's revenue growth over the last 5 years. It's slightly more than Singapore's GDP for the last couple of years. And also, we believe that this is a very conservative estimate given the sort of market that they are entering right now. The effective income tax rate is assumed to be 17% going forward as well. So based on that, based on our DCF calculations, we have arrived at a price per share target of $2.87, which is at a significant 54%. So we see a 54% increase possible from the current price of $1.87.
So looking at industry peers, firstly, the valuation indicators. So we see that our PE ratio is a bit lower. We estimate that our industry peers are more mature, are more scaled up, and are probably more exposed to the 5G market. Looking at the profitability and quality, so our cash flow on net income is a bit lower than the industry. We estimate that we have limited bargaining power, and so a lot of our cash is still trapped in growing receivables. Looking at leverage, so our leverage might seem high, our debt to assets versus the industry, but our financial debt is actually close to zero. So this high ratio comes from other liabilities, such as deferred revenue coming from, we believe, the services. Looking into valuation, so we believe that PE ratio is the most representative of all. So our multiple comes at 23, and applying that to to our metrics, we come at a target price of 3.46. Now, what are the risks of this this company? Well, we see two major risks. The first one being obviously the customer concentration. So as we said before, 94% of our sales are coming from the same customer, which is Intel. So this leads also to a bit of seasonality within a certain year based on the manufacturing needs of Intel. So they kind of mitigate that through the multiple acquisitions that they do. So for each acquisition, they try and target different customers. So in their recent acquisition, they were able to target Huawei, and with their most recent acquisition, Mutest, they're able to serve, I would say, niche semiconductor players. Intel is itself also a stable and large company. Then the dependence on M&A. So M&A is really part of their strategy. And so we see some risk in there. If there's a wrong acquisition, it can affect the business quite badly. But since they have done 3-4 very successful acquisitions in the past 2 years, we think they really have the expertise to integrate and to and merge well with the companies. So to conclude, we've seen that the market is positive. So our company might seem quite risky, but in a portfolio of other more conservative stocks, we believe our portfolio is quite balanced. Looking at drivers such as 5G, IoT, and cloud services, the market of chips is increasing with almost a 50% CAGR over the last year, in the upcoming years. And subsequently, we can derive that chip testing market will increase as well. So AEM itself, so they have proven to be a well-established company with a previous sales growth. They're able to handle complex manufacturing solutions. They have a powerful customer. They serve it very well with a customized solution. And on top of that, they're slightly increasing their customer base. They have done fruitful acquisitions, which it stands at the basis, we believe, of our increased target price.
Thank you so much for your time and consideration.
Thank you very much. We'll now turn it over to the judges for questions.
I have a question. So I understand the drivers of the industry, 5G, IoT, I get all that. I guess the real question is, I don't have a good grasp of who the competitors are. So you have 94% share at Intel. Who's got the other 6, and what makes you confident that 94 is not going to 40 or 50? And then secondly, who are the competitors at Huawei and Qualcomm and the other ones? So give us a sense of where these guys fit in the overall industry, because I'm thinking that you are part of the thesis is that these guys will do a lot of M&A, but why aren't they an acquisition target if some of the other players are larger and have more scale?
Okay.
So Intel actually forms 94% of their revenue. So Intel is their major customer. In fact, they have long-term services, long-term service contracts with Intel, in which they have formed certain contracts where they are the sole supplier of these testing equipments. At the same time, they have built these relationships over the last 15 years with this big client of theirs, and have provided customized chip services. With the collaboration between these two clients, they've actually found a way of reducing these back-end costs for Intel by about 50 to 80%. So that is why they do not really have a lot of competitors. They have kind of monopoly in the market here, and to also diversify vertically. They're doing all these acquisitions, so that instead of relying only on one client, they diversify into other kinds of services, such as cable manufacturing and testing, and now they're moving into memory chip manufacturers, and again their testing equipments. So that is one of the reasons.
Yeah, and with regards to why they are actually, we would be very happy if they would be an acquisition target. So currently, one of the issues that is there is that the shareholding is very fragmented. So for any competitor to come and try and buy them out would not be an easy proposition, because they would have to negotiate with multiple different stakeholders. So that is why we feel that, there is a certain moat around them being acquired. Yet, if they were to be an acquisition target, the first problem that any acquirer would face is that they would have to get Intel's approval, and that they would have to pay a fairly significant price, because the shareholders of the company are actually strong institutions who will not be able to sell it at a cheap price. So there are a couple of moats around which make it sort of not an acquisition target, very easy acquisition target anyway.
But maybe my first question was confusing, but they can't be doing all the test and measurement for Intel, right? There have to be other firms working with Intel, test and measuring their chips, right? So why are those guys not trying to box these guys out or take share from them?
I think for AMs, they are focused in back-end testing. So only one part of the testing process, and they have their advanced technology. We mentioned they spent 8 years developing the HDMT testing platform. So this platform is their most advanced technology that other competitors cannot touch their back-end testing part. That's why they have this advantage when they negotiate contract with Intel. And also at the moment, they're also developing new technology for the new Intel 7nm chips. So they are in this backtesting area. They are the most advanced and cutting-edge technology.
Also, there's a reason why Intel doesn't want other competitors to come in here, like their other competitors, because Intel is actually been very, very happy with these guys. So it doesn't really make a lot of sense for Intel to say, you know what, hey, you don't need to do any more work. We'll push it to a competitor. They really don't want to do that. So I think it's sort of a quid pro quo that's really working out well for both companies.
Well, I generally like semiconductor and the semiconductor cap equipment sector. But I know, the competition restricts you to pick a stock in your home market, and Singapore is small. So I guess that's why you came up with this AEM company. But clearly, this company is really very risky because, like you said, 94% of the revenue comes from one company, from Intel. Yeah. And so you can talk all you want about, 5G and IoT and Huawei. And I think I see some chart you show a lot of the revenue growth coming from China, but that's all kind of irrelevant, right? It's really one client company, right? It's only Intel. And I don't know if you really understand the dynamics of the sort of CPU market and the logic chip market. Intel is falling behind quite badly against AMD in terms of technology. Those guys are doing 7nm, and Intel has been stuck at 14 nanometers forever, and much delay even in 10nm. And in fact, the stock has been lagging for many years, but now recently it has kind of broken out. And you know the reason why? Because there are rumors that Intel will give up manufacturing, that they will also outsource manufacturing to TSMC in Taiwan. I think from investment point of view, that may be good, but from a national security, from US, talk of revival of manufacturing is horrendous. It's a national security disaster. So this company that you're recommending is really, dependent on the failing, basically, chip manufacturer that's losing market share. They skipped over the entire mobile generation. They got nothing in mobile. They don't have anything in AI, in GPU. They claim to want to get into IoT, but they're used to, like you said, high-end, high power consumption server chips. This is completely opposite to IoT chips, which should cost like, a few pennies or like 20 cents. So, overall, I like the semiconductor market, sexy, 5G growth, IoT, but it's kind of all BS. Intel is the loser. So have you looked at that? Are you aware of this?
Yeah, we are aware of it. Actually, I was just reading an article earlier today, where AMD has been increasing its market share quite rapidly in the semiconductor industry. We are aware of that, but we believe that Intel will still, it's a growing market, right? So despite Intel losing market share, they are still able to grow their revenues and grow their business to a certain extent.
So what if they give up manufacturing? Then can AEM get into TSMC? Can they get into Samsung?
They've actually partnered with Huawei again exclusively for their 5G rollout, which is currently starting.
Huawei doesn't make chips either. Huawei chips come from either SMIC for the lower end and TSMC for the high end.
Yes,
Huawei doesn't make chips.
But not just for the chips, for their cable testing as well. So with their recent acquisition, which is Inspirane, they've gotten into cable testing solutions, and that is what they're implementing with Huawei.
That must be 0.5% of their revenue.
Yes, and that is why they've identified this risk with Intel and are slowly moving towards other clients. In fact, they're also in talks with Qualcomm, which is again one of the biggest companies to gain from the 5G rollout. And they've already started working on the cable testing part of it, which the rollout that's going to happen in China in I think first quarter of 2020, second quarter of 2020. It's already started happening. So they are already diversifying. They've seen that outlook already, and they're moving to change that.
Okay.
Also, one other thing that you say, that why did we pick this company? So the idea was that we believe that in the current scenario, the stock price is definitely undervalued. And if you see the stock price movement over the last 4 months, our sort of thesis has come to fruition. We did pick this risky stock in a portfolio of very sort of safe stocks. We had looked forward and thought that Singapore will likely go through recession, and we had designed our portfolio along those lines. So we picked this company as an outlier to try and get some extra alpha returns out into the portfolio, and the other 4 stocks are actually very safe defensive bets.
Why do you think these guys pay a dividend if it's such a high growth market and there's so much opportunity to do acquisition and grow? Why are they paying out their free cash flow in a dividend?
So it's, while they do make, while they are investing a lot of money into acquisitions, their capex is typically fairly low, and they're generating a lot of free cash flow. So there's no reason for them not to give out the dividend. And also the sort of stakeholders that are sitting on as shareholders of the company sort of would demand that kind of dividend as well. Also, the chairman of the company owns his own private equity fund, which also has a small stake in the company. And so I would assume that the design of the company structure is that, generate high free cash flows, send some back as dividends, and then use the rest for M&A and maybe a little bit of capex, which is not a bad model at all for shareholders, I think.
Right. Majorly, the capital expenditure is very low, again because they produce customized equipment for their customers. So because of these they also do a little bit of designing of the equipment as such. So that's why, because of that, they have a lot of free cash flows which they choose to, because of what Rudy said, give out as dividends.
They're also doing a buyback. They plan to buy back sort of 10% of the equity over a period of time, provided they get a fair price for it. So the last tranche that they did was about 100,000 shares at $1.74 or so.
We reached out to the investor relations of the company to understand exactly what the motives behind these policies, these investments are.
This is roughly what we got. Yeah.
So we're just going to take one more minute. Any additional questions? Okay, thank you so much, Singapore Bulls. We're now going to...
Thank you.
Have a good day. Thank you.
We're going to take a brief 10-minute break now. Welcome back, everyone. It's time now for team number 3, GSB. Team GSB, you're on. Yes.
Retail company. As part of choosing this stock, we followed an investment thesis that concentrated on 3 main criteria. Firstly, in terms of industry analysis, we looked at companies that were less susceptible to systematic risk, and companies, again, that were non-cyclical in nature in the face of economic downturn. In assessment of the stocks, we preferred a look at long-term value as opposed to short-term growth, which was based on the previous performance of the stock and a forward-looking perspective in terms of its future performance. Lastly, we looked at financial metrics in terms of the actual company's performance, which we will get into more detail on the following slides. But in brief, some of the key insights that we were able to obtain from a deeper look in terms of the company's performance was the fact that Clicks has 8.1 million active Club Card members. This contributes a large portion to the data that the company is able to work with, not only in promoting additional sales to its existing installed customer base, but also being able to prospect future sales, which has greatly contributed to the company's operating efficiency. In terms of benefits for shareholders, we've seen an increased headline earnings per share, 16.8%, and again, dividends grew by 17%, which we felt was quite a healthy growth. So in some of the key performing metrics, in terms of Clicks share price, as we can see over the past 5 years, not only has it greatly outperformed the all-share index, even within itself, it's showing considerable growth year on year, which we see as a long-term value prospect. The margins have remained not only high, but also sustainable, as well as their EBITDA percentages. We also looked at the company's cash flow return on investment, specifically in comparison to the company's discount rate. As again, we can see that it's not only sustainable, but also far above the discount rate, which we see as a far lower risk. And lastly, in terms of their economic profit, we've seen considerable growth year on year, with the promise of continued growth moving forward. Lastly, we assessed the company's ability to not only invest capital, but as a result of the invested capital, to look at the return that they've been able to achieve from an economic profit perspective, as well as from the ability to grow their asset base. For financial year 2020, the company's planned to invest 718 million rand, and a further 700 million rand in 2021, which, according to past performance and the performance looking forward, we're obviously quite confident in their ability to again realize substantial economic profit on this future invested capital. The next slides will show a deeper analysis into the market sector, and my colleague Thanesh will take us through that.
Thank you, Curtis. Thank you, judges. So having looked at Clicks, we want to give you a little bit of an understanding of why we actually focused on Clicks. And as we noted, we were looking for a market sector that would be more or rather less susceptible to an economic downturn. And so we looked within the retail space in FMCG. And of the segments within FMCG, we can see in the chart on the left that our retail pharmaceuticals have managed to maintain fairly steady retail sales growth year on year, despite unfavorable economic conditions. And so having identified that pharmacy retail is fairly stable in terms of retail sales growth, we looked within that market segment. And as you can see, Clicks is the dominant player, followed closely by Dis-Chem, and then followed thereafter by a large fragmented group of independent pharmacies. It's also worth noting that Clicks' small store format makes them or positions them better to potentially acquire these small independent pharmacies should there be any consolidation in that space. Dis-Chem is not as well positioned to do so because they largely have a large store format that's incompatible with the independent pharmacies in the local market. And then zooming out, we just wanted to look at across all of FMCG. So the charts on the left compare Clicks to some major players in the FMCG space. And as you can see, Clicks has managed to maintain the highest, or about the highest, so the second highest CFROI and economic profit, second only to Mr. Price, which is a clothing retailer in the local space. But why we favored Clicks over looking at a company like Mr. Price is that Clicks has managed to sustain a high ROE, achieving the highest ROE in that market segment of over 40% in the last financial year. So again, zooming into the pharmaceutical space, we compared Clicks to their largest competitor. And as you can see in FY19, Clicks was able to outstrip Dis-Chem's same-store sales growth. And they've also managed to outstrip Dis-Chem's profitability and EBITDA margin over the last 5-year period. So again, we noted that there are some significant systematic risks in the South African market, and we've just highlighted 3 of them. As you can see, South Africa already has very high bond yields compared to other emerging economies. And the pending risk of Moody's credit downgrade, or the threat of pending Moody's downgrade rather, is that it may force foreign investors to withdraw investments from South Africa, which would severely impact our local capital markets. Attached to that, we also have kind of internal issues in that our local electricity provider, Eskom, as you may know, is having major struggles in producing sufficient amounts of electricity to support and drive the economy. And all of that is having an impact on overall GDP growth. You can see it's been very slow, average 1.6% over the last 10 years. And this has had a knock-on effect on employment and consumer spending. But as my colleague David will now go through, while there are some headwinds there, it seems that consumer confidence may pick up. And as we kind of explored, Clicks is relatively insulated from this risk. So I'll hand over now to David, who will take you through that data.
Thanks very much, Dinesh. So just looking at investor confidence, we've seen a decline into negative territory as households have been experiencing tighter income amidst high tax rates, as well as soaring electricity prices. We've also seen investor slowdown. So we've seen that the foreign investors are starting to pull large amount of South African equities out of their portfolios, which further shows that consumer confidence is at an all-time low. But given on the graph on the right, the index is showing that in 2019, it started to decline, and as well as 2020, it will be declining, but should pick up in 2021, which should then bolster sales for Clicks. And then we looked at 4 international factors affecting emerging markets. So the first being the US-China trade war. So South Africa, being an open economy, is open to this risk that the that the trade war currently exposes us to, as well as US fixed income markets. So the low bond yields continue to support the case that equities can be currently priced at a high level. Looking at USD strength, so the South African stock market usually declines during USD strength, but we ran a regression, and what we found is that clicks actually appreciates over that period. And finally, looking at the coronavirus, we wanted to see what the long-term impacts of that would be. So we took during the announcement of SARS and Ebola outbreaks, and then took an average of those two to see what kind of market impact actually has on these type of epidemics. And we see that the JSE and clicks performs worse than the S&P over the period, but does after one trading year continue to appreciate. And then just looking at market implied discount rate, which kind of gives us an idea of how the market's pricing equities. So looking that the US market's currently pricing equities much higher than the South African market, therefore showing that South African market does actually have some potential to grow given the current stock that you're looking at. And then just looking at our forecast. So our forecast is based on current capital expenditure over the next 3 years, and taking into account same store sales, margins, and their gross investment, and their ability to provide economic profit of that gross investment. So looking at the top left, the revenue has been increasing, or we do forecast it to increase, because of their current plan of opening 30 new stores, as well as their distribution side of the business, who's got 2 more contracts. So we should see revenue increase there. Economic profit as a percentage of gross investment, given their current store rollouts, we don't see that it's feasible to continuously maintain a high level of economic profit of gross investment. And then just looking at dividends. So this stock is a company pays out really high dividends, and that's one of the most attractive benefits why people invest in it. But given their current expansion plan, we can't see them actually paying out a large amount of dividends over the next coming 3 years, but should steadily increase. And just wrapping up, so our final share price of 207 Rand is based on an average of discounted cash flow and PE valuation. Our PE is a 28.825-year past average with a 12-month forward revenue. And our discount valuation is looking at a 3-year explicit forecast. So what we just looked at the slides, or the previous slide. So looking at how we can forecast that, followed by a 2-year stage 2 stable driver forecast. And that's looking at the past 5 years of historical data and how we can forecast that forward. And finally, a terminal growth rate of 4.5%. And that was calculated using GDP, CPI, as well as long-term growth within the company. And then just looking at the 2 sensitivity analysis tables. So the one on the left looks at the fade rate or the competitive advantage of the company. So just looking at how the company's been operating, where the market's currently pricing the share price, it's currently pricing it between 2 and 5%, showing that the market doesn't believe that this is open to competitor risk. But should we see that, we might see the share decline. But if it continuously improves, then we will see the share appreciate. And that's kind of followed on to the next sensitivity analysis. So looking at which driver is the most effective for forecasting the stock. So looking at operating expenses as well as sales growth. Given the current infrastructure plan for UDP, we should see operating expenses decline slightly, as well as revenue or sales growth increase, therefore pricing a much higher share price than we currently have seen. And just coming back to our investment thesis. So given that we're looking for a company with long-term growth and a company that has maintained a high CFROI, this is why we believe Clicks will perform well in the long run. Thank you.
Thank you very much. And now we will begin the judges' question and answer.
Okay, thanks.
I had a question. Do people pay for the memberships, or is that something that's you just sign up for and they keep track of all your information?
Yeah, the memberships are free of charge. So when you enter a store, they will always say, do you have a club card? And in the event that you don't, they'll be quick to offer you one at no cost.
Okay, and when it comes to the competitive situation, you mentioned, you showed in all your data that they seem to be outperforming the direct competitor, the main competitor. That's just due to store size?
Yeah, I think it's due not only to store size, but I think that location could also be a factor. There's definitely, they've got strategic locations. So yeah, as Dinesh mentioned briefly, some of their stores are a little bit smaller. So I think that they're able to position themselves in a lot more locations as opposed to Discam.
And then just another factor linked to your initial question on the club card, Click seems to have been able to leverage their customer analytics way better. So they're able to predict demand and make sure that they're marketing specifically to individual customers. So they send out email blasts based on your previous purchases. And we find that they've managed to do that a lot more effectively than their direct competitor.
Yeah. And just to add to the Discam versus Clicks. So Discam doesn't own its own distribution company, whereas Clicks does. So it's able to maintain that high level of efficiency rather, which can be shown in their operating margins.
So why do you think, I know that it's it's not supposed to be a fast growth company, but given all the advantages you've laid out, why are they only adding 30 stores a year? Is there any reason why they're not adding 50 or 80 or 100?
Sure. So I can answer that. So we've seen in the past that companies that do try to grow too fast, given the current economic climate within South Africa, it won't actually be favorable for the company. So rather than maintain or holding on to all the cash, they'd rather pay it out as dividends instead of just growing for the sake of growing. And another thing that we found was looking at how do the management team actually, or how the management team are incentivized. And they're incentivized over long-term growth and not short one-year performance targets.
I have a question. Can you hear me?
Yes.
Yes.
Oh, well, it sounds like South Africa is having a pretty tough time, and that's why you guys emphasize the fact that this choice is very defensive. Consumer staple, especially in I guess pharmacies. But I mean, and then you mentioned that electricity is rising, right? The price of electricity. So why not pick a utilities as your stock, or like telecom, or like a power company? So that's my first question. Second question is that, you claim this is defensive, right? I guess it's a pretty good, track record, but it looks like you're saying it's 12-month forward PE. You assume it'll, just stay at the last 5 years average, which is almost 29 times. And yet the economy is growing at 1.5%. Sales growth, I guess, is what, high single digit, low double digit at best. And earnings growth maybe also around there. So PEG is like well over 2 times or even 3 times. So usually when you pick a stock which is PEG 2 or 3, that's not defensive at all. So yeah, so how do you answer that?
Sure. So just to answer your first question, given telecoms and utilities in South Africa, that's actually been one of our most volatile industries, especially in the telecommunication space. We've had lots of corruption scandals. We have 3 major players within the telecommunication space, and those scandals have actually rocked the share price to even up to 70% of their current valuation. And then just to answer your second question. So yes, it does have a high premium PE. But looking at other competitors and the way that they grow for the sake of growing, if that be in industrials, we don't feel that that market is as sustainable as something as fast-moving consumer goods or something that normal people need on a day-to-day basis.
Two more questions. One, why do you think they don't have leverage? Because typically companies like this that are stable cash flow generators tend to at least lever up a little bit to grow stores or do something. So why no debt? And then secondly, why do you think, given the backdrop in South Africa, the economy and the things that you mentioned, why do you think the stock has done so well?
So the first question for on leverage, because they're such a high generating cash flow business, the question is, do they need to take out leverage to actually grow the business? And at this stage, they don't, given their current expansion plan. We've seen companies, as I mentioned before, that grow too fast, that can't actually hold their margins, and with that doesn't actually fit their investment thesis or their kind of growth thesis rather.
And then why have they done well?
Yeah. So, do you guys want to take that?
Yeah, and I think just based on why they've done well, I think again they have a fair mix of kind of discretionary items in their product line, but mostly products that are anyway money. So whether times are good or times are tough, you need to buy a lot of what Clicks is selling, and that coupled with the loyalty that they've built with their club card program means that they're less susceptible to downturn. And again, I think compared to their direct competitors, they've done a better job of maintaining and steadily growing their customer base, which is why we think they've done better than the other competitors, and then I guess also done better than the rest of FMCG.
But I meant it looks like the stock has gone from, I don't know if it's $9 to $25 over the last couple of years. That's right?
Yeah, that's something like it.
That's pretty good for an economy that's not really growing and has all the issues, even though it is a staple.
Sure. I think there's also been, so within the company, I don't know if I mentioned it earlier, for international investors looking to invest or diversify their portfolio, the company actually holds 71% and up from 6% last year of international investments. So given that, I think that also promotes that they have seen that high share price growth, and it also emphasizes the scope that investors are looking for.
Thank you very much. I think we're going to have to turn now to the final team. Thank you so much, GSB.
Thank you. Thank you, judges. Thank you, Yale.
Very much, judges.
Thank you.
Okay, welcome Brazil next. The floor is yours.
Can you hear me?
Yes.
Good morning, everyone. Thank you very much for having the opportunity to be here today, present this case. We are Brazil Next Team from Fundação Getúlio Vargas, FGV. My name is Junior, and I'm here with Flavio, Rocha, Melissa, and Cynthia. Our top pick company, long-term oriented and strong buy recommendation today is RD, Raia Drogasil SA. I will hand the company's presentation to Flavio on the next slide.
Okay, good morning. RD currently has 4 main brands with targets different locations and customers. Drugstore brands are complementary and they focus on different market segments. So we have Droga Raia, a more upscale brand with focus on wellness, women, and families. Drogasil, a traditional drugstore brand for seniors and pharma, and the Pharmacil, a low-cost store aimed at lower-income neighborhoods, and finally, Onofre, a recently acquired brand of pure play price-driven strategy with 45% of revenue coming from digital service. This platform is currently being integrated. The company is also strong at digital and omnichannel strategy, which are developing quite fast. It is prepared to get more clients from this segment as well as from physical retail. I will pass to Melissa now.
Thank you, Flavio. So in terms of strategy, as Flavio mentioned, RD is the largest drugstore chain in Brazil with well-established iconic national brands. The company benefits from expertise in sundry channels, including different store formats and digital initiatives. We believe it's the best positioned group to capture the segment's long-term growth perspective, driven by population aging, increasing income per capita in Brazil, and also raising healthcare awareness in the country. In the short term, the company benefits from positive momentum, which supports volumes growth and its strategy to accelerate market share gains. In the long run, we expect same-store sales gains from store-based maturation, as we will show in the next slides. So moving forward in the presentation, as we can see on the right of the page, following the merger of its two main brands in 2011, which are Raya and Drogasil, the company has pursued an aggressive expansion strategy through both organic growth and acquisitions. In the third quarter of 19, the company reached around 13% of market share in the Brazilian market. In October 19, the company reached 2,000 stores with presence in 23 states of Brazil out of 26 states. So RD is currently present in more than 350 municipalities and has around 34 million active customers, which actually means that roughly 16% of the Brazilian population bought anything from RD in the last 12 months. So moving forward, we see on this slide the positive momentum that the company has undergone in the last few quarters, driven by the continuous recovery of the macroeconomic scenario in Brazil and better competitive environment in the sector. Same-store sales from May2 stores have actually surprised the market in the last few quarters, and we expect growth to keep pace in 2020. As we can see in the right of the slide, revenues growth and net stores addition have decoupled from the industry in the last few quarters. We also expect the company to take further advantage of the positive momentum to continue to gain market share in 2020. So moving forward, following the guidance of 240 new stores in 2019, in gross terms, RD has recently released a guidance of an order 240 new stores for 2020, adding up 480 new stores in 2 years' time. Due to the company's accelerated expansion plan, the stores' base profile is expected to be younger in upcoming years. In our view, approximately 63% of stores will have reached their maturity in 2019 end of the year, which has not been released yet, whereas this figure goes down to 56% in 2021, which means that most of the same-store sales gains will probably come from stores' base maturation and the ramp-up curve. Although near-term perspective is also positive for May2 operations, we have been very conservative in our analysis and projections and considered May2 stores' growth only in line with the Brazilian CPI. So if we move forward to the financial projections, as we mentioned, we have been very conservative on sundry aspects of the projections. So as for top-line growth, it's coming only from expansion and stores-based maturation. We're not considering same-store sale gains for May2 stores in real terms. Margins actually consider a slight drop in line with the company's aggressive strategy of raising market share. So gross margins would be around 30%, decreasing to 29.8% in the 5-year period, and EBITDA margin of 11.6% is expected to decrease to 10.9%. This is not considering any gains of scale, for instance, which could eventually happen. We did not consider any synergies from recent acquisitions, further M&A transactions, or top-line gains through omnichannel and digital strategies, although those could eventually happen as well, given the strong cash flow generation of the company. And we have considered a WACC of 10.16%, which is quite conservative for the current Brazilian scenario, given the reference rate, the 4.25% levels nowadays. So if we think of that, moving to the next slide, and given the previous page assumptions, we believe in a base case target price of 134 reais per share for December 20. And at year end in December 19, the share price was 111, but it has reached the maximum of 128 in January this year, which is much more aligned with our projections. So in our base case scenario, we had 123 reais per share for December 19, okay, which was reached actually in January. If we consider a scenario with a positive momentum for major stores to keep pace in 2020 as expected, and also synergies from the recently acquired Onofre's platform, we could reach a target price of around 145 reais per square meters, which is the bottom right scenario. And we actually believe in this more bullish scenario, which seems to be much more in line with the company's actual strategy, that would represent a 20% upside potential for this share in the 10-month period, compared to a 10.8% for the base case scenario. So these will be the upsides for this share. Regarding the risk factors and in terms of risks, we believe main threats to the company could come from slower than projected maturation curve for new stores, and also rise in drug benefit programs, which could impact both the company's competitiveness and margins. Our other potential risks would present lower probability and impact in our view. And I will now pass the word to Junior for the final considerations on the presentation. Thank you.
Thank you, Mel. As we have discussed, our topic is R&D, and we believe it represents a great opportunity in the Brazilian packaged market. RD is the largest drug chain store in Brazil and is the best positioned company to benefit from the positive long-term trend in the sector. Also, it has been pursuing an aggressive expansion strategy based on both acquisition and organic growth. It benefits from the long-term know-how in the sector, as well as from the different brands, store formats, and digital assets targeting sundry consumers. Financials are solid and will benefit in the short term from current positive momentum and the medium to long term from the storage-based maturation. Main concerns would be a slower ramp-up curve and the highly regulated environment. But we do not believe those factors will have a relevant impact in the short to the medium term. We keep a strong buy recommendation with a base case target price of 134 reais and an implied upside 10.8%. Thank you very much for your attention. We are available for any question you might have.
Thank you so much. It's time now for the judges' questions.
I think, the first question is, this company is trading at 75 times forward PE. Is that correct? Historical, I mean, in fact, it jumped from 38 times in financial year 18, which is already very high, to 81, and now 76 times forward PE. And it looks like the sales growth is again quite ordinary, right? Like, am I correct? Like 13% sales growth, and profits growth, I think, is even a bit slower, like 10%. So how do you justify such sky high valuation? And I assume interest rate in Brazil's actually fairly high, right? So that, you know, usually should push down the fair value of a stock. So, you know, unless this company can grow at much faster rate than, you know, what you're projecting, otherwise, I don't see the investment case at all.
Okay, thank you so much for your question. We actually believe that the company is not only the largest company in Brazil, but the only one that could benefit from a sector that is actually consolidating. So if I might just skip to a market perspective. Okay. Okay, so that's what we have for the projected growth in the segment. It's a segment that's growing a lot due to consumer awareness and mainly from the aging population in Brazil. And it's not consolidated at all. So the major player in the sector has 13% of the sector. It's about to be consolidated. And RD is the only publicly held company that is present in 23 states in Brazil, and it generates a lot of cash flow. So we do believe that further M&A transactions will take place, and this is already priced in our model. So we did not consider any M&A transactions. We just consider a growth through organic growth. But we do believe it's in place to actually consolidate the market in Brazil. And the second player would be much lower than that. It's present only in two states of Brazil, which would be Rio de Janeiro and São Paulo, and it's not even a publicly held company. So RD would potentially be able to buy several smaller players and local players and actually be the one company in Brazil for drugstores. That's why it's valued so high. In our
that makes it even more vulnerable, because obviously if you are trading a very high multiple, you have a very expensive currency to be used for M&A, but usually the case is that, yeah, that benefits the target company. Usually then the stock price goes up, but the acquiring company stock price tends to go down exactly for that reason, because it's overvalued. So you want to use the currency to do acquisition, but you know, once that happens, then the stock will go down. Are you familiar with M&A?
Yes, but we do believe this is a movement that's going to take place in the medium to long term. And this company will also have a bargaining power much higher than other peers. So we believe it's very well positioned to keep its valuation further.
Do you guys have do you know what the multiple was that they paid for what they bought the CVS stores?
Not really. I don't really have this information right now.
Okay. And can you guys talk a little more about one of the last risks you mentioned was prescription-free drugs could be authorized at supermarkets, and it looks like it would potentially affect 30% of their sales. So the likelihood of that and what they might be able to do to counteract that?
Of course. There is a project running in the lower chamber, and that's the third time it runs in the lower chamber, for free drugs to be sold on supermarkets. And those drugs would be like the simple ones, such as for headaches and stomach aches and so on. This project has already not passed the lower chamber twice, and it's running for the third time. And it's going under sundry committees in the lower chamber to be adjusted. So we find it hard to get it approved because there is a lot of pressure from the pharmaceutical industry and from the drugstores for that not to happen. And if it eventually does, we believe it will be a soft form of the law that will not get to impact 30% of revenues. So these would be a perfect storm scenario. For that to happen, for the approval to take place, this will be for the medium term. We would say it's not a priority in the Congress, not this year, not the next year. So we see it as a risk, and we would, of course, write it down in the report, but we would not consider it as relevant as it seems.
I didn't look, but can you tell us how the stock has done recently?
Of course. So if I may move the presentation a little bit, if you allow me to, just a moment. Some technical issue here. Okay, let me try to do this again. And I'll show you the I'm sorry. So mouse is not really helping me out here.
It's okay. It's okay.
So if we go, if you remember the second slide of the presentation, so we actually ended up the year of 2019 in 111 reais. By October last year, we were around the same path, but in September it was around 105 reais, and in January it actually got to 120s, high 20s, and it got down to 121 yesterday. So it just went down together with the Ibovespa, which is the ETF index and movement, but we do believe that it's about to go up. Okay. So that's the movement. It's been priced in with Onofre's recent acquisition. And actually, the fourth quarter results were not priced in yet because they're going to be released in 2 weeks' time. So we expect that when that happens, shares will go up.
Yeah, I'm just curious about, because to the question earlier, I mean, obviously the valuation's high. I'm just curious if it's being priced. I mean, this is a drugstore essentially, but it's been doing acquisitions and it's got rapid growth with this omni-channel sort of call option. So I'm wondering if it's being valued more as a growth stock than a traditional slow-growing drugstore chain.
Yeah, we believe so. We have actually classified this stock as a growth strategy. and they don't really disclose the breakdown of digital strategy yet in the P&L. So we don't really have it. I can imagine it's not really representative yet, but it's growing in such a pace that it will become representative at some point. And with the consolidation of Onofre, whose 45% of revenues come from digital segment, we believe this is bound to grow in a faster pace even. So it's going to become relevant, and we didn't even consider that on our projections.
Thank you very much.
I just want to ask about consolidation. Are there enough large opportunities out there, or is the business fragmented across Brazil so much that it's very hard to just bite off a couple of large pieces where they're going to be having to roll up lots of mom and pops, lots of very small stores that are harder to move the needle on a company that's obviously much larger?
Yeah, the business is quite fragmented and composed of local players with central stores, but locally placed. So next M&A movements would have to be local. So I understand the company would have to define a strategy to enter new markets or markets where they are not strong enough yet through M&A transactions with local players and well-known brands and in each state, for instance. But the second largest player would have less than 10% share. So it's very fragmented.
Thank you.
Thank you so much. Brazil next. We are now going to turn to the judges' deliberations, and we will announce the winners shortly.
Thank you.
Welcome back, everyone. The judges have deliberated, and we are nearly ready to announce our winners. But first, we wanted to give the judges an opportunity to give each of the teams a little bit of feedback on their presentations. So, judges, please present your feedback for team number 1, the Wujiao Chang Alliance team.
Okay, let me start. I think the choice is quite interesting. I think it fits with the national theme of energy self-reliance. I think Shale is a novel concept in China. So I think that's quite a brave choice. But as I mentioned in the Q&A, I think your team should understand maybe the geology of China a little bit better and the markets of natural gas, of unconventional natural gas in China better, because you don't seem to understand the cost versus the market. So I think I think that's the thing for me. And also I think the judges discussed that I think 70% of the business in China, and then they seem to have 30% in the US, and you didn't really talk much about the overseas business, especially in the current situation, with high tension between US and China. So is that still a viable opportunity, and so on? So I'll stop there. Adam, Michael?
The only thing I would add is I think you guys did a good job, but I would have liked to have seen a little bit more about the peers and really some analysis or more presentation as to why these guys have such an advantage. You touched on the technical advantage, but what do the other competitors have? Are they really competitive? Pricing, things like that, I think would have been helpful.
Great, thank you so much. And now feedback for the Singapore Bulls.
Okay.
You guys presented an industry that's interesting to all of us judges. We really like semi equipment in the larger tech space. I guess the presentation was well done. The only hang up for me, at least, was that the leverage to Intel is so extreme that probably deserved a little bit more focus overall, because the risks to Intel deciding to delay a project or to move on from a certain sub-industry could be really disastrous for that projection. And I would add also, we didn't get a sense of how long the outlook was that you were looking for. Were we talking 18 months to 3 years, or are we looking 5 years? And that probably, just in terms of scaling it in my own head, might have been helpful. But otherwise, I really enjoyed the presentation. So that was a great job.
Yeah, I think the high dependence on Intel is obviously an issue. But yeah, I mean, I totally agree. I think semiconductor, is a very strategic industry. I think going forward in the future. And I think what would have liked to hear a bit more on is about the technology. Actually, what kind of testing do they do for Intel? And also, a hot topic is, again, the trade war and the sort of related tech war. So how vulnerable are they to, like, this Huawei ban, right? That we have been experiencing. So what the U.S. has imposed right now is any company that has a 25% U.S. IP or component threshold would be subject to that Huawei ban. And in fact, there's rumors that it will be lowered to 10%. So I would have liked to learn more about their situation. Will they be subject to this Huawei ban? And what if the threshold is lowered further? Then what will happen? And also, I didn't have a chance to ask the question, is that I think in your presentation, you mentioned that the highest revenue growth is coming from China. But like, are they testing the chips for Intel in China, or where are they doing the testing? Because I don't think Intel, certainly they don't manufacture the chips inside China. So are they testing it at the data center? So I didn't have a good understanding about that. Okay.
Thank you so much. And now feedback for Team number 3,
Are they testing the chips for
GSB.
My comments for you guys, I thought it was an excellent presentation. What I really liked was how you guys opened by just discussing what it was that you were looking for, what the criteria was, and how you got to the stock. Because I think for us as judges and looking at all your different markets and not knowing what criteria you guys are using, whether you're looking for growth stocks or value stocks or whatever, to sort of lay out what it was that you wanted, why, and how it fit the criteria, I thought was excellent. And I thought the way the presentation flowed made it very easy to understand how you were going from the opportunity, the valuation, all that stuff. So I thought it was very good.
Yeah, I agree. I tend to find that you got a sense not only of clicks, but also of Discam and what separated the two and made this more of a unique investment thesis rather than something else. And also it's in a secular business, though. The backdrop of South African economics and consumerism is certainly a story that continues to evolve. But you certainly made a good case for it. So well done.
Yeah, I tend to concur. I mean, to be honest, I think it sounds like South Africa's situation is not very good. So it's a bit of a sad story. And then I asked the question, if you want to be defensive, why couldn't you pick a utilities? But then you explained, I'm vaguely aware of it, is that, even telecom is even worse. I don't know if the power utilities are listed. So yeah, I mean, within the criteria, I guess the best you can do is to pick a consumer staple company, even though it's not trading at a very cheap valuation. But I guess that's all basically you can choose, right? And I guess it sounds like it's a good long-term secular growth story. Yeah, I agree.
Great. And so now we're just going to do some feedback for Team 4, Brazil Next.
I found that to be an excellent presentation as well. Really well laid out and very convincing.
Yeah, I would agree. I thought I liked how you guys incorporated and really framed the total market opportunity, how much of a population they were addressing, the demographics, why all of it was sort of coming to them, where they sat in the competitive universe among being the largest and how it's fragmented. I think all that was excellent as far as understanding the opportunity.
I think the presentation is fine as well, and it's sort of like a bit of a roll-up strategy. They're doing merger and acquisition, but already I pointed out is that I think even given the opportunity and the strategy, unless there's something else we're missing, otherwise it's hard to justify 75 times valuation, price earnings valuation. I'm not expert in Brazilian market, but I struggle to understand how that valuation can be justified.
Thank you so much. I just want to take a moment to thank our judges for participating today, for listening to the presentations and for providing feedback to the teams. And I want to thank all of the teams for participating and for tuning in from all around the world. It's now time to announce the winners. So Eddie is going to announce the second prize runner-up team.
Yes, congratulations to the Fudan Wujiachang Alliance.
Great job.
You are runner-up, a second place winner.
Congratulations. And then we will have our judges from Stralem and Company announce the first prize winner.
Again, you guys all did a great job. I feel guilty doing this, but the winner in our estimation is the Clicks Group, University of Cape Town. You guys did a really fantastic job. Congratulations.
Congratulations to Cape Town. Well done, everyone. Thank you so much, and have a great rest of your day or evening.
Okay, all the best.
Thank you.